Welcome, savvy investors, to yet another YouTube live session. Today, we got a great training session. For those that don't necessarily know who I am, my name is Mike Ponte. I'm the founder of Savvy Investor and longtime Canadian real estate investor. I hope everybody's doing well. It's been a crazy year. We're coming to the end of 2023, and today's training session is kind of a highlight of what's kind of been transpiring here over the last year. And it's specifically for those that are getting into the kind of the commercial multifamily space and are considering getting into CMHC financing for their investment project. For those of you that are getting into multifamily, looking for commercial financing, throw it in the chat. Let me know who's acquiring or refinancing their multifamily projects, because I'm sure this is near and dear to everybody's heart. As the old saying goes, those that have the money make the rules. And in this situation, it's the banks, unfortunately. They're the ones that make the rules, God forbid, right? But to help kind of ease some of the risk and some of the pressure that tends to kind of come along, and to help kind of fund more deals, the Canadian government body, CMHC, is helping insure these banks so they can fund more deals. But even these individuals, CMHC also has rules as well. Wah, wah, wah. Nobody likes rules, right? Especially my kids. But it is constantly changing. This is the thing. Being an investor for a long time, and our guest speaker has also been in the business a long time. This is just a constant evolution that's always happening. And the banks are always changing the rules. As soon as you think it's going one specific way, it goes in a completely different direction. So thought it'd be really important right now is to communicate that everybody should be reaching out to their investment team. It's very, very important that you should have somebody there to help always kind of provide you with some guidance of what's transpiring, especially in the financing world. And so the one way to do it is go to your financial advisor or your mortgage broker, your commercial mortgage broker, and make sure you have connections with them. Or you join us here on Savvy Investor to learn more as well and get a chance to connect with a real, true expert. And our special guest, very, very near and dear to my heart, Dalia Barsoum, who is from Streetwise Mortgage, joining us to share a little bit of her knowledge and give us the behind the curtain look when it comes to CMHC financing. And so with that being said, we're very, very honored to have Dalia here. So for those that have maybe been living under a rock, I'm not sure, Dalia is no stranger in our real estate investing community. She's a renowned speaker, columnist for the Canadian Real Estate Wealth magazine, a contributor to various media outlets as well on the subject of real estate investing and also financing. She's been featured on Rogers TV, Toronto Money Show, the Toronto Investors Forum. And for those that may have seen her on stage at the multifamily conference, which I did, she did an incredible job. Well done, Dalia. And very investment groups as well. So she plays a really pivotal role for a lot of real estate investors in our community. And she helps rookies and even some of the most seasoned investors financing a lot of their multi-million-dollar projects. So I couldn't think of a better person to have this discussion, even though she's a little bit nervous about some of the hard-nosed questions I'm going to give her. No, I'm just joking. I'm going to be really gentle. Dalia is the best, right? So before we kind of get started, I also wanted to highlight that this training session is brought to you by our good friends and our trusted partners, Rocket Station Virtual Assistants for real estate investors. So Rocket Station is the leading virtual assistant company who specializes in supporting real estate investors. So if you're feeling overwhelmed with some of the mundane tasks in your business, like bookkeeping, tenant screening, social media, marketing, all those wonderful things that we all hate to do, consider Rocket Station Virtual Assistants as being part of your investment team. To learn more about Rocket Station Virtual Assistants, click on the link in the description below. And for you savvy investors that are joining us or watching the recording as well, you guys get a little bit of advantage. You get a $500 discount off initial setup costs. I use them myself. I can't say enough good things. So if this is the year of scaling and growing and looking for help, maybe consider them as part of your investment team. So in addition, last but not least, before we bring in our speaker, this is a YouTube Live. I can see your questions. I can see your comments. This is all for you guys. So get those keyboards clicking along, share your questions, share your comments, because we want full engagements to help support you, to help you kind of kickstart things off. If you haven't done so already, please subscribe to our Savvy Investor YouTube channel. Give us the thumbs up. And in addition, it keeps you informed of our upcoming videos as we have them available. So without further ado, let me welcome our special guest, Dalia. So Dalia, how are you today? Let me just unmute you first as well so you can talk. How are you doing?
I am excellent, Michael. I'm excellent. Thank you very much for the generous introduction. I'm very happy to be here today.
Oh, it's so easy to do because you're an amazing person. So thank you so much for being here and being willing to share. So you want to start off with a really hard question right off the bat? What do you think?
Let's do it.
So you know what? I'm joking. We'll start easy. So Dalia, a lot of people recognize you in the industry, but maybe for those that don't necessarily know who you are, maybe you could share a little bit about your story, your journey, maybe as an investor, as a mortgage broker as well. Just, you're very active on social media. People will recognize you, and we've got people literally all over North America watching this today. So maybe you can highlight a little bit about Dalia.
I started in the mortgage industry, Michael, in 2011 with primary focus on income properties because I was an investor myself starting into this industry, and basically really developed a methodology around how to scale real estate portfolios using the best cost of money. Personally implemented it for myself, and over time helped investors piece that money puzzle together in a strategic way to continue to grow and grow while really being strategic and managing risk. Prior to that, I worked for the banks for 15 years in wealth management and in the residential and personal and commercial banking and in lending.
Wonderful. So lots of experience, obviously. So very, very good. And how long have you been in the industry for now?
Well, in the mortgage industry for 12 years.
12 years. Okay. So you've seen a thing or two.
Yes, I've seen everything from investors starting out to investors really building empires and becoming the Grant Cardones of the world. So it's been an amazing journey that way. And I personally, as an investor, invest in the Barrie, the Peterborough markets, and right now in the Toronto market, and of course in private money.
Love it. So let's get to the main topic at hand. To be honest, it's been an interesting year. I'm assuming you would agree with that. With interest rates going up, and we're seeing things slow down in the market, probably a little bit of panic for some people. And really where I wanted to kind of skew things a little bit, and for those that are watching, I'm sure everybody's interested, because I see a big evolution or big adjustment. People are trying to scale. They're trying to get into commercial financing. They're doing CMHC financing. They're in the middle of project. But guess what? The rules have kind of changed. So maybe you can highlight, maybe just to begin with, let's start with the most simplest thing, because we got a lot of people that are relatively new in the industry. And what is CMHC financing, and why and when would people be considering and using CMHC? So we'll just go with the most basic questions of what it is, if you don't mind.
So CMHC money is essentially the cheapest money on the street, whether you're doing commercial financing or even residential financing, because it's federally regulated, and it's an insurance that basically protects the lenders when lenders give you money. So that money becomes less risky for the lenders to lend you, and therefore it's cheaper, and they're more comfortable giving extended amortizations on that type of money. So to give you an idea, in the commercial space right now, if you were to go to a traditional lender on a building, right, and you're asking for a traditional mortgage, and let's say that building qualifies, you're looking at rates in the 6s right now, okay, government of Canada bond plus 2%, roughly. And if you were to go to CMHC, for example, now you're looking at rates in the 4s compared to the 6s, and you're looking at amortizations up to 50 years under the CMHC MLI product versus a 25-year amortization with a traditional lender. So investors love CMHC money because it gives them, better cost of money essentially, and higher loan values and extended amortizations.
Yeah. And not to mention, also adds a little bit of this into everybody's pocketbooks a little bit more too, right? And we talk a lot about this on Savvy, is about cash flow, and for a lot of people have talked about it as well, is trying to find ways to cash flow, and that's one of the arrangements and one of the strategies people have been utilizing, especially the CMHC MLI Select program, to take advantage of that. Lower rates, longer amortizations, giddy up. It makes sense, right? But as we were just highlighting and alluding to earlier, is that there's been some changes as of late with some of the recent rules that are coming up, right? Like a big look, I see you get a smirk in your face, but it's the truth of it. It's changed, right? And even myself, I got caught off guard with this, and I'm like, what's going on, right? So maybe for those that, again, this is important for everybody paying attention, which comes to the headline that we set this whole setup with, is for those that are getting into multifamily, these are rules that everybody needs to understand. Would you agree, Dalia? Like these are some changes everybody, to understand your strategy. So maybe you can share a little bit about what are some of these changes that have occurred and how it's maybe impacting people. So.
Okay, so since we're talking about CMHC changes, I will do a quick run through of the changes CMHC has been introducing actually since 2020. And what I want to say, Michael, before highlighting these changes is that in lending in general, things are changing all the time. I know investors get upset and frustrated when things happen, but I can tell you this, whether it's residential or commercial, conventional or insured, things change all the time. And we just have to figure out ways to keep growing and going, and life doesn't stop. So we control what we can control. So when it comes to CMHC, back in 2022, the first rule was around equity takeouts. They said if you were to take out equity from a property that's been renovated, you can only use this money to support housing. You cannot use this money to pay back investors. So you had to sign a statutory declaration saying, I'm going to use this money to either build a multifamily or renovate a multifamily or, use it, towards multifamily improvements. So that was the 2020 rule, which really was not a huge change for many investors because a lot of investors use money and recycle it to do more. All right. And then February 2022, the MLI Select got rolled out and was a huge hit, right? Because of all of the features. And then in June 2023, they said, you know what we're going to do is we're going to now increase the premiums. So the program is still around, everything is still around. However, you're paying more premium to CMHC to participate in that program. So the premiums have increased. Okay, no problem. You know what? If the numbers make sense, the numbers make sense.
Exactly. Yeah.
Life goes on. Then September 2023 comes and they come up with a rule that says we're now going to only pay off lenders that are on our approved list. So if you go to Google and you look at CMHC approved lenders, you will see who is on that list across Canada. And what that means is if you have a private loan or a lender on a property that is not on this list, or a vendor take back not on this list, they're not going to pay out that lender, which really meant that now investors have to go into a stepping stone called bridge loans or a temporary lender that is on that list before they go to CMHC. So what did it mean? It meant really inconvenience to investors, additional cost. But again, life goes on. We keep going. And now recently, September, again, 2023, a new rule came in saying, okay, if you are doing a renovation on a building and it's a repositioning, which is the key strategy for a lot of investors, you go in, you increase the net operating income, you increase the value, and you want to obviously turn around, refinance, take it out, and rinse and repeat. They said, we are now not going to pay off loans on these properties unless you've been with that lender, which has to be CMHC approved, for 24 months. So that is a big change. That one is a big change. But I wanted to deconstruct what it's all about. Here's the thing. This is not a general rule on all refinances, okay? That's what I am finding. What I'm finding is that CMHC is big on construction. They want new units. They want investors to create housing. So anything that is built from the ground up, okay? Anything where an investor has changed the use of the site, let's say it was commercial and now it's residential, okay? I am seeing, some exceptions around this rule because it's a new construction. It's like built from the ground up. It created new units or a change of use. But when it's a building that was existing and there were tenants or it was really a renovation, not a true construction.
Right.
that's where things are getting a little bit tighter. And we have to look at alternative ways, especially for clients, let's say, who had taken money and got into this point and they haven't been with that lender for 24 months. We are looking at new ways of doing these deals.
Yeah, and I think that's the thing. You know what? It's been investing for over 20 years. These are just yet more changes in an industry that's always changing. There's always a way to pivot. There's always a way to kind of adjust things. It's always the way about the numbers and for it to make sense. So it's not into panic mode, but the important part is you got to talk to your experts to kind of highlight what are some of the options. You brought a comment about CMHC approved lenders. For those that are watching the recording and are watching this live right now, what I will do is I'll add the description, or I'll add in the description a link to who those approved lenders were. And so then everybody has that as a reference for themselves as they're watching this as well for themselves. So very, very good. So comes kind of to the next question too. And again, these rules kind of applied. It kind of came out, especially the 2-year thing, right, Dalia? Like that just happened like just all of a sudden. And then
Yeah.
But here's the interesting thing, guys. Okay, a lot of people were actually in the middle of their projects, and all of a sudden, surprise, Merry Christmas, Happy New Year. It's just like, wow, this is great. No, it's not. Maybe you can highlight some of the challenges that's caused. You know, a lot of people got caught completely off guard of this. So how does this actually affect potential and existing investors right now looking to refinance? Because they've gone in with a specific strategy and they would have talked to somebody like yourself and said, Dalia, this is kind of the plan of attack. This is what we're looking to do. And all of a sudden something's changed. So maybe you can highlight how this has impacted people. And for those that are watching, just pay really close attention. It's important you understand this, right? So
yeah, so how did this impact people? So like you said, Michael, you have investors who are, let's say, done their renovation and their initial plan going into the deal was, I'm going to take private money or construction money and do my takeout with CMHC. And now they can't. So what are they left with? I mean, some investors are put in a situation as a result of this where the construction lender wants out or the private lender wants out.
Exactly.
What are they going to do? So here are some of the options that are available right now. One of the options is to obviously take a conventional loan, like a 1 year or a 2 years conventional loan, if the numbers work, because under conventional financing, you're not going to get a 35-year, 40-year, 50-year amortization. You're going to get 25-year amortization, and the maximum loan to value is 75%. So one option is to, if your numbers work, and yes, you're going to be leaving money in the deal, beyond what you initially anticipated. If the numbers work, you go down that route, and then that gets paid out. But in some cases, that is not an option. So what options do these investors have? Well, and one option that I am utilizing right now is to go to a lender that offers different types of funds under their umbrella. So what do I mean by that? That lender can offer a bridge. They can offer what's called a term loan, and they can offer also CMHC loans. So what I'm doing is I'm going to that lender or these lenders and saying, hey guys, I have an investor who's ready for takeout, or they're close to takeout, but we can't do it because they haven't been with anybody approved for 24 months. Can you give me a bridge loan to clear up this time-sensitive money that they need to get rid of? And then that takes us, forward to, let's say 6 months forward. Of course, there is extra cost. And then we replace that money with a term loan with that lender. So we're not switching lenders, right? So that lender is willing then to give them a term loan, let's say 18 months, 24 months, and they can have a fund internally at 30-year amortization.
Right.
That will be lower than the bridge. And it gets them to that finish line to then switch that to CMHC. And again, because you're doing it all, it's like stepping stones with the same lender to get to CMHC. Of course, there is extra costs involved, but because it's with the same lender, you're not doing appraisal on top of appraisal and fees on top of fees. So that's what I've been utilizing to help investors.
And that's actually a good question. So here's kind of a second part to that question. Is you highlighted this a few times. And for those again that maybe in the brand new space in multifamily, there's a lot of extra costs that come along with financing, commercial financing. It's just what it is. You get the appraisal, engineering report, environmental appraisal, all those wonderful things. And some of it's very similar in the residential space, but in the commercial, it's a little bit different. So when you highlight extra costs, can you maybe just highlight what are some of these extra costs, Dalia, that people can kind of prepare? Again, you mentioned this earlier. It's always about the numbers. Do the numbers make sense? You just got to start to budget that these extra costs may come up twice, 3 times over. So you just need to kind of understand that. So can you reference what are these things? And then even more importantly, what are the timelines that we're seeing from the banks in regards to requiring yet another report, if you don't mind?
Yeah, so the typical cost with any commercial loan, right, is you have a lender fee, you have a broker fee, and you have an appraisal that has to take place. And depending on the loan size or whether or not we're going to CMHC, there has to be an environmental assessment. These are the repeat type.
Standard. Yep.
When you're going to CMHC, of course, they charge their $200 per door. So let me go back to the structure that I talked about. You're going to a lender. Initially, they're going to need an appraisal. So here's a $3,000 at least that has to, you have to pay to appraise the property. And then they're going to give you a bridge, which is an interest-only loan that comes in at, let's say, prime plus 2 or sometimes even 3. Like prime is 7.2 right now. So you're looking at an interest-only loan at anywhere from 9.2 to 10 point something, and then they charge their fee, which can range from anywhere from 0.85 of the loan amount to 2%. Again, everything is negotiable. My role in the process is to package your deal so that I mitigate the risk for the lender and also help the lender see the potential of further relationships with them down the road so they can give you better deal knowing that there is more to come. So that's part of the entire, role of us brokers. So lender fee, broker fee can range anywhere from 0.5 point to sometimes, 2%, depending on the size of the loan. But if you're going to one lender and you're going to do a repeat loan with them, so a bridge takes you 6 months out to clear whatever pressure you're dealing with right now. And now we have to switch that to quote unquote what's called a term loan. A term loan is an amortized loan. It is principal and interest payment versus an interest only payment. Yeah. That then may not require another appraisal because an appraisal is good in the lender's eyes for a year. Okay, I can use it for a year. So you could potentially save there, and the lender will not charge again a 2% to give you a new loan, but there may be a small fee both on the lender and the broker, and then the interest starts to go down. Now you're not talking about prime plus, we're talking about potentially the government of Canada at 200 points. So you're looking at probably the 7s versus the 9s. And then when we go to CMHC charges their fee. The lenders typically don't charge any big fees at that point. They may charge a flat fee, a small flat fee, and that's typically, that's what you can expect. But CMHC at that point will, if we're going to CMHC, ultimately, a lender who knows that they're going to eventually go to CMHC will require an environmental assessment upfront because they don't want to be in a situation where they pay a loan and then when the time comes to go to CMHC, they discover there is a contamination or an environmental issue.
Exactly.
So they would want to do that.
Yeah, and it's something that for me as an investor, and I even teach this to a lot of my students, is like, get the environmental, especially just up front, because they're going to probably ask for it. CMHC is probably going to ask for this. You don't want to find out about that surprise after when you try to refinance that. Your conventional lender, your private lender, they may not request it, for the small cost of $3,000, $4,000, $5,000, $6,000, whatever. Especially when you're looking at a bigger project, it's a drop in the bucket. But you're better to determine that there's no issues than finding out and surprise it happens, right? So I had a student of mine that's had a bank that said, I don't need to do an environmental. Guess what? They did it anyway based on a recommendation, and they did it, and surprise. There was a gas station that was there many, many moons ago. They had to do it. It required a phase 2 study. Now, all of a sudden, that was a little bit of concern, right? So, So let me ask you now. So, thanks for sharing this about the cost. And again, guys, it's all about understanding your numbers. And I think this is where you start to talk to your experts. We've always said this, you need these people as part of your investment team that really understand the rules of engagement, because the banks, as I said earlier, they make the rules. It's their money. They're going to make all these rules to facilitate. And people like Dalia have to understand what the rules or the sandbox that we're playing in so they can give us the money. So it's important to kind of understand it, know what the costs are going to be associated. Does it still make sense in your deal when you're needing to kind of do this whole bridge arrangement? And I actually think you provided some great insight, which I hope everybody caught on, is if you're switching from lender to lender from the bridge loan, it may cost you a little bit more, but if within that same facility, they may not charge you that extra cost. If that's correct, Dalia, is that right?
That's correct. Yes. Yeah.
Yeah. Perfect. Good. So can I ask, just based on your experience right now, who are you feeling has been kind of caught in this situation with some of these new rules? Has there been anybody specifically? Is there people specifically that have been really, really caught off guard with this thing based on your experience?
I think the folks who are impacted the most are the folks who are using creative financing and were expected to switch from creative to CMHC, whether that's a private or a vendor take back and or a combination of both. Typically, that's in my view, the mostly impacted clientele, because it's a double hit, right? One, private is not an approved lender, and then the 2-year situation on top of that. So it's that the two changes in policy impact that investor.
Yeah, I agree. And for me, what I've been seeing is a lot of private lenders got hit pretty significantly. Is again, it's not that they've been hit where they've lost money. It's just they've been wanting to get their money out based on a specific timeline, but everything's now been delayed in a different perspective. I mean, would you agree with that?
Exactly. Yes, absolutely.
Yeah.
Yeah.
And what are you seeing kind of maybe, and this is good for even our private lenders that are listening, again, for you guys that have invested with a company or an individual, and I don't understand their business by any means, and I'm not justifying it, to be very, very clear, but it's understanding that your real estate expert also significantly got caught off guard with this arrangement here. So what are you seeing, maybe extensions? Have you seen extensions of where private lenders were expecting to get their money back? Is it taking them an extra year, 2 years? What are you hearing and seeing just based on your experiences, if you don't mind?
Are you referring to commercial only or everything?
It could be everything, to be honest with you, but we're talking commercial, but why not talk about everything? Because I think it's important to hear about it, right? So
yes. So let me comment on both. On the commercial side, definitely the private lenders are being asked for extensions, right? Potentially 6 months to a year sometimes, believe it or not, because here's the thing with CMHC, Michael. They are putting, I'm finding that in terms of processing, right? We know that they take long, but in terms of priorities given, I find, to buildings that are like construction from the ground up, that's priority. Purchases is a priority. Refinances, and then eventually assumable mortgages and switches, right? So refinances and takeouts are like the number 3 on the list in a way, right? So with these new rules coming in, that's stretching things further. And I've seen private loans, being asked for extensions 6 months, sometimes in the very worst case, a year. So that's on the commercial side. On the residential side, the challenge is a little different because with residential, the exit is really dependent on the personal qualification, not the property qualification. In commercial, it's the property. In residential, it's you and I. How much income do we make? Do we earn?
Right.
Yes, we carry, right? And what happened over the last year is the qualification bar has become this high. It's turned from the stress test to what I'm calling the impossible test for qualifications. So for folks to qualify, it's become harder. Property value also started to shift in some markets. So you take shift in valuation, you take tougher qualification, and now the planned exit is not necessarily falling in place the way an investor envisioned it, and a private lender is being asked for an extension until that investor, figures out an alternative. So different challenges, but yeah, private lenders are being asked for extensions all over the place.
Yeah, I've been hearing a lot about this. And again, I think it's just important that everybody understands it. Even for you guys too, that are looking for private lending to get into this, make sure your timelines are reasonable and make sense. And again, make sure you involve your mortgage broker, have that discussion, make sure everybody understands what you guys are doing before you kind of transition it that way. So, so we've talked a little bit about CMHC and I want to kind of get a better perspective of what you're seeing just from financial institutions' perspective as well. Have you find just conventional lending changed a little bit just in some of the new policies and rules that have been implemented with CMHC? Have things tightened? Have their requirements, have they become requirements changed a little bit? Are they maybe a little bit more cautious because maybe it's taking longer? That means they're requiring more conventional, like we're talking about bridge loans temporarily for a year. How accepting are they? Is this something that they're like, yep, we're willing to take it on. We're willing to take on the risk. We're going to get paid a lot more. What are you finding in general from conventional financing?
Commercial in general, whether it's conventional or CMHC insured, I'm finding that the lenders are cautious in general in terms of, where they're lending, how far they're going. Especially in the smaller markets where the populations are tiny, they're really selective. And for these deals in particular, to be honest, I'd rather work with a local credit union that knows the market and wants to build a relationship with members locally, and they're more comfortable than someone bigger lending in that small market. But overall, I'm finding the lenders to be cautious across the board, and we as brokers have to show how we're mitigating risk. How are we making sure that, the risk on multiple fronts is mitigated? Meaning, if an investor is renovating and they're planning to finish this project in 12 months, do they have the experience? Who's on their team? Is there skin in the game? What if something goes wrong? Is there liquidity in the bank? Like the lenders are being more selective about risk. Especially when the bond market was really like swinging and going crazy. Now the bond market, as you know, Michael, the bond yield has declined, and it kind of ticked up one point just after the CPI news, but it kind of stabilized. It was going crazy.
It was.
During that volatile period, the lenders were really cautious. Things are improving, but I wouldn't say they are like liberal yet.
Being very respectful. That's very good. There's a question that's almost perfect timing with this, actually. So I'll just throw this up on the chat here for you to see. So Jay Martin, thanks for asking your questions. And for those that are watching this live, post your questions. This is for you. This is what it's all about, guys. We're here to help support you guys in your journey. You got questions about CMHC? We've got a CMHC expert kind of joining us today talking about financing. So let's go to the question. Jay Martin, thank you so much. Dalia, will CMHC do smaller mixed-use buildings or only larger commercial residential buildings? I'm assuming multifamily. Also, are CMHC mortgages available in smaller areas under 50,000 population? Great question.
Great question.
I'll pass that on to you. Go ahead, Dalia.
Yeah, so this is a two-part question. The first part is, do they do mixed-use buildings or only larger commercial residential buildings? And the answer is they do mixed-use buildings. However, the commercial square footage cannot exceed 30% of the total square footage, or the revenue from that space cannot be greater than 30% of the total revenue from all units. So if you have a mixed-use building where there are 3 commercial stores at the bottom and 3 residential units at the bottom, at the top, that is like 50%. That is not a CMHC deal. But if you have a space where you've got multiple residential units and the commercial space is just like below the 30%, then that could potentially be a CMHC deal. With respect to markets, CMHC is comfortable going into smaller markets And that's actually where the comfort level for many lenders is in smaller markets. Some lenders, if you ask them to lend without CMHC in a smaller market, they wouldn't do it. But if, you know, mom and dad are behind the scene protecting that lender, you know, in that smaller market, they would consider lending in the smaller market, because the risk of default, yeah, or the risk of that property not selling in a smaller market is is hedged, because CMHC is protecting the loan. So they would lend in a smaller market with CMHC stepping in.
Yep, very good, awesome. So James, I hope that James Martin, I hope that answers your question. It was a very, very good question. So thanks for asking that. There's another question that came up, Dalia, from Joshua, and it looks like another really good question as well. So I'll just read it. Does the new 24-month CMHC requirement affect the MLI Select energy efficiency approach? Meaning, will CMHC recognize a pre-reno energy assessment that is 2 years old? So.
Okay, so here are two ways to use this MLI product. Okay, if you're, I'm assuming, Joshua, we're doing a renovation, some sort of a renovation here, right? We're not just like doing a straight acquisition mortgage. So there are two flavors of this. The first flavor is someone takes some sort of money to, you know, acquire the building and do the renovation, and they plan their equity takeout with CMHC, whether it's on the regular front or the MLI Select. And the 24-month rule under that scenario applies if this building is not built up from the ground up, if there is no change of use, if it's just like a building where you've done a renovation, then the 24 months rule applies. But let's say you're taking CMHC construction financing from the get-go. Okay, from the get-go, you're actually, you know, getting CMHC money to turn around the asset. Then your takeout is pretty much guaranteed if you're taking CMHC MLI construction from the get-go. They're not going to give you construction if they're not going to do the takeout.
Yep, perfect. Good,
So,
Josh, I hope that, oh, sorry, keep going.
Yeah, so if time is on your side, right? If time is on your side to close with CMHC MLI from the get-go, I would suggest doing that versus the old model of let's close, do this, and then do this later.
Perfect, perfect. Joshua, I hope that answers your question. Again, great questions by everybody. Thank you so much for sharing that. So let's get back into the question in regards to some of the rule changes in general. And again, I am just highlighting it based on the rule changes, Dalia. Have you seen changes in just maybe on the market dynamics, just in general? Like, have you seen things slow down? Have you seen things pick up? Because this is kind of, you know, we're watching stats constantly all over the place in regards to, you know, what's going on with the markets. And have you noticed any variations or changes that have happened because of these rules, specifically in the commercial space?
I've started to see more buildings come on the market that are, you know, in reno mode.
Oh.
But Michael, I may be biased because, I mean, you go to a doctor and everybody who's stepping into the doctor's office is sick, right?
Yep.
So you ask the doctor, are you seeing sick people these days? And the answer is, yeah, I see them all the time, right? So I'm here at my desk and I see certain types of rules, and, you know, I don't have, you know, like Canada view of the world and every market and every property. Mind you, we're soon gonna have some really great data sources that we can lean on and guide our investors through. But to answer your question, I'm seeing these types of deals come on the market because the deals that are coming to me here are, okay, I'm buying this building, it's on the market, and the seller is renovating, but they don't want to finish the project. So the person who's acquiring it doesn't need to deal with this new rule because it's an acquisition.
Yeah, makes sense.
Finishing the renovation has to deal with the new rule.
That's the problem, right? Yeah. Yeah, that's it. Interesting. Okay, good. Very, very good. So what do you think? Do you, you know, I don't know if I see your crystal ball behind you, the Dalia crystal ball that you have. I'm not sure. Mine's a little dented because it got bruised up pretty badly this year, but maybe in Dalia's crystal ball, and again, we're not holding her accountable, guys. This is just visual vision. What's your kind of thought in regards to the forecast, your future forecast of what's going to be happening, I guess, specifically with regulations? You see more coming from CMHC because of this? Do we see things tightening up even further? Do you see maybe things loosening up? Obviously, we a lot of discussion about interest rates specifically, and we're hearing like 2 to 3 rate increases. Nobody necessarily knows, or decreases, I should say. Nobody technically really knows. But when it comes from a CMHC perspective, are you seeing anything or hearing anything in the landscape in regards to further policy changes?
Okay, so I don't have the crystal ball, but I always consult with this llama that you see right here. Her name
I see the llama, yeah.
Her name is Lola, the lending llama, by the way, and she's the one who I consult with. I actually don't know if there are specific changes coming from CMHC, but what I know is that there is always a concern, and an increasing concern actually by the regulators, both on the residential and the commercial side, about the markets ahead and generally the level of Canadian debts. And there is always talk percolating about tightening things up. Does it mean that it's going to happen? Not necessarily. Example, in the residential market, there were talks about tightening things up for a long time by OSFI, and everybody panicked. And they only implemented one change, which is not a huge change. But to answer your question, there is always talk about tightening things, but are they going to happen? I actually don't know. I don't think anything is urgently being talked about right now beyond what we've seen at this point. And right now the market is talking about potential rates easing up in 2024. So that's where the spotlights are right now.
Yeah, I agree. Like I said, it'll be interesting to see what happens in the next coming year. Again, the one thing that I've learned in the 20 years of investing is the banks are always changing the rules. They're always adapting. They're always changing things. They're tightening things up. They're loosening things up. It's all based on what's going on in the economy as well. But more importantly is, as an investor, there's lots of ways to pivot. I've learned how to do this 1.5 million times over and over and over again. And it's just, there's always a way, but you just have to talk to your broker, talk to the right people to help support you, and make sure you provide them with a clear vision of what you're trying to do and start to build a true game plan with that. So comes to my next question is, we were talking about, kind of what are some of the best files in regards to what CMHC is looking for right now? So could you maybe highlight what is an ideal file that CMHC loves to see that comes across your desk that is relatively easier to approve based on some of the new policy and rule changes that we're seeing right now?
So CMHC wants to create housing, right? So construction from the ground up is something that is attractive. It's creating housing. However, with construction comes risk. So CMHC wants to see that whomever is building has experience in building, or has someone with skin in the game in building, or they have someone that they've hired who's done this before and obviously knows what they're doing, and there is enough to manage the risk of the project. But these projects, when they're well packaged, they like them because they're creating housing. It's
perfect.
Yeah, but does this mean are these the only deals getting done? Absolutely not. All of other deals that we talk about, like refinances and the purchases and the switches, they're still getting done. But you're asking me what's most attractive right now: new construction and anything that is also tapping into the MLI product. It's new construction that marries MLI, creating accessibility, creating energy efficiency, creating affordability. These are getting attention because that's what he wants to see.
Yeah,
You're creating housing at the same time, participating in these mandates.
Yep. Very good. Perfect. Love it. So we're going to kind of tie this up. So maybe final words of advice. So we got a lot of savvy investors going to be watching this, and they're watching the recording. And when it comes to kind of financing or refinancing their commercial properties using CMHC or considering using CMHC for a project, there was a comment that was referenced that they got some properties under contract and not too sure what to do. What would be words of advice that you would give to our savvy investors that if they're considering CMHC as part of their financing strategy in their analysis?
Validate your assumptions. What I see sometimes investors come to us saying, I'm buying this so that I can exit with CMHC in this time frame at these terms, and they've run their numbers based on these assumptions. And the assumptions are not exactly, 100%, because maybe they're using private money and they didn't account for the fact that they need a stepping stone before they go to CMHC. Or a common mistake that I see, Michael, is thinking that CMHC's MLI program is good for 95% loan to value or loan to and the reality is, yes, in theory, but at the end of the day, the property's ability to qualify for the loan is driven by its net operating income and the debt coverage. So you got a property value at 5 million, 95% of 5 million is what? It's like 4 point something. But if you run the math and that property only qualifies for a $2 million loan, CMHC is going to give you 2 million. They're not going to give you that 95% that's written on paper. So my point is, validate your assumptions with someone who understands how it works. And obviously, sometimes things change, but there are ways to pivot. And that's the game. That's the game of investing. That's the game of lending. But assumptions, I find, is where things catch.
So true. Yep. Been there, done that. I've done that many, many times in my past as well. So guys, don't get caught up with this. That is some serious wealth of wisdom there. So Dalia, you know what? This is amazing stuff. Thanks again for being here, sharing some of your valuable information with our community. And I'm sure a lot of people got a lot out of it. If people want to learn about Dalia, where can they find you? Where should they connect with you?
Info at streetwisemortgages.com, Michael, or at our website at streetwisemortgages.com. Awesome.
I think that was a comment actually from Joshua as well. So Joshua, just click on the description. I've already put it in there for everybody. Connect with Dalia. She is very highly recognized in the industry and is very, very experienced. So anyway, thank you, Dalia, again for being here. So I want to thank you again for sharing some of your wisdom with everybody that's part of this. So thanks again.
My pleasure. Anytime. And if any of the folks watching this today have questions or want a second opinion or feel stuck, my team and myself are here to help you guys. And whether you're early on in your investment journey or the Grant Cardone of the world, we've seen it all, and we can definitely assist you.
Love it. So good. So as we wrap things up, guys, for those that are watching live and the recording, thank you again for being part of this, for watching this training session. Hope you found this to be very valuable for you. Please do me one small little favor before you leave. Hit that subscribe button, hit that notification bell, help us grow our Savvy Investor channel, as we'll keep you up to date of new and upcoming videos that we upload. So regardless if you're watching this live or the recording, please post your comments or questions below for myself. And if I can't answer them, I'm sure Dalia would be very kind enough to answer as well. So again, with that, thank you for joining us. And I look forward to seeing you at our next Savvy Investor YouTube Live. Cheers.